Today, we're talking financial regrets.
These regrets tend to lean towards the bigger things in life. The two that come out every year and are usually the top two are I wish I saved more for retirement, and I wish I didn't take on as much credit card debt.
That's Stephen Cates, financial analyst at Bankrate.com, talking about their latest financial regrets survey. And you can see how your emotions over money and what you've done or haven't done shape up against the rest of the country. But we're also going to talk with Nick Pisano from Clever Real Estate about their research into why a whole lot of people have regrets when an Airbnb moves in next door. Plus, I will talk about the regrets I am having been hacked and dealing with the consequences, which includes having some money stolen from me. And John Cole Scott, president of CEF Advisors, is here talking closed-end funds in the market call, and I promise you will not regret listening to that.
Hello. 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 Hello.
Welcome to Money Life as we enter September here. Yep, hard to believe we're that far into the year, but we're going to try to not regret what we've missed out on the summer, get other things done, etc. Yeah, this is hopefully a no regrets edition of Money Life, though I will say there are regrets being talked about for sure because, well, it's not just that, yes, I got hacked and then I got robbed and what have you. And I'm not going to focus on the regret of did I do enough. I'm going to focus on the regret I have that I got to go through a bunch of things that I'm going to talk to you about because I want you to protect yourselves. Because what I'm finding out is that the stuff I'm going through is much more common than people know, but we don't share it enough to know that oh, wait, hold it. This is what's happening to us. I'm hopeful that we can get you through that so that you don't face regrets, both from being ripped off at some point, but from them not knowing what to do. But we have two surveys today. One talking about regrets, one talking about what happens relative to your property when an Airbnb comes nearby. And that's been a thing, so we'll have a little fun with that. And then John Cole Scott is here. That is not what I promised you on Friday. I promised you Rob Thummel from Tortoise. He was supposed to be here today. We taped that interview, and I will not explain what happened. You do not need to know the specifics, but that interview and another interview we taped with him in advance for later in the week are both gone. I will, again, not go into the details, but I promise you, this one was not my fault.
It's not your fault, Chuck.
Damn straight. But when I found out that we didn't have that interview... Yeah, that's pretty much how I reacted. And then I wound up swapping notes with John Cole Scott, and he said, hey, I can jump in if you need me to do something. So we're able to give you a show that doesn't have to rebroadcast things. And I like that a lot better than if we had to rebroadcast.
Dude, I'm sorry that I've been bumming you out, but it's not my fault.
Now it is my fault because I've been telling you about all this other stuff, this sad sack stuff that happened. And I am going to do more of that when we get later. But I want to keep as much time as I can because I do want to be able to get to that. So remember, you can write me in if you've got any of the shared experiences we're talking about today. I would love to hear from you, and I'd love to help incorporate that in. This is not going to be the last time I talk about getting hacked, etc. So write me, chuck@moneylifeshow.com. I promise you won't regret it. Right now, let's get to this show. Again, it's Stephen Cates, me, Nick Pisano, John Cole Scott. We'll talk about regrets first when we come back in a moment.
Looking to earn CE credits and hear from top portfolio managers? Go to etftrends.com/webcasts and learn more.
Now Money Life looks at what the survey said. This is the survey said on Money Life. It's where we dig into surveys, studies, polls, any kind of research or data that's going to help us understand what people are doing for, with, and about their money. And today, what we're looking into is the regrets they might have about their financial situation, because there is a financial regrets survey recently released by the folks at Bankrate.com. And it suggests that, yeah, plenty of people are feeling the pinch of pain, at least emotional pain, if not financial pain. If you want to learn more about it, well, Bankrate.com, the website, but we have a direct link in our show notes and on our guest page where we mentioned my guest. Stephen Cates is a financial analyst at Bankrate.com. He was involved in the research. Stephen, great to have you here on Money Life.
Thank you for having me.
I try to live my life without regrets. Like, I just don't have time for it. It's a better way to do it. And I guess I'm not surprised that almost 3/4 of Americans have regrets when it comes to their finances. But how much of this is I have regret because, when I was young, I didn't save enough money, which is a regret you can pretty much have for the rest of your life, even if your finances turn out okay. And how much is this, I have a regret because earlier this year, I spent too much on this thing that now I found out I don't really need.
So these regrets tend to lean towards the bigger things in life. The two that come out every year and are usually the top two are, I wish I saved more for retirement, and I wish I didn't take on as much credit card debt. And those are repeats year after year. Student loan debt is also in there. Wishing you saved more for an emergency fund is usually one of the top five as well. But those are the type of things that most people are looking back at and wishing that they had been a little bit more on top of.
When it comes to having those regrets, are they doing anything to narrow them now? Because, if I had a regret with something that I said to somebody, I would try to make amends. If I felt I didn't save enough, I would try to save more. If I felt my debt was too high, I would try to pay it down. Do they have regrets, or are they working on removing and atoning for their regrets?
So both, really. What's interesting is that compared to 2024, we're seeing that there's actually a slight decrease in the amount of people reporting financial regrets. The biggest decrease came from younger Americans, actually, Gen Z and millennials primarily. But for those people who did report having financial regrets, we're seeing many more people say that they're making little or no progress in addressing those. And that's probably the most concerning thing to me.
Play that out a little bit. Is that because you can't get off of the regret cycle that way?
Well, I think it tends to show that, comparing this to prior years, because we've run this survey for a number of years. And so it's interesting to look at it year over year and through some of the sort of economic tumult that we've had. But people are saying that they're making less progress now than they thought they would compared to the same survey in prior years. And I think it shows that people are finding it harder to do the things that they need to do to make that progress, whether that's save a little bit more money or try to pay down some of the debt that they have or make better decisions about their finances. And a lot of this, I think, speaks to the weariness that many Americans feel around their finances. People said that the things that might improve their finances are cheaper essentials, lower rent, better job opportunities, higher paying jobs. And I think they're not finding those things. We're seeing rising inflation again. We're seeing a slowing labor market with very slow hiring, slowing wage growth. We're seeing rent prices and housing prices high. And that's wearing on people. And I think they're feeling like they're just stuck or falling further behind.
There was a little bit of shift in the top worries in that we normally have it be, I didn't save enough for retirement or I have too much debt. And it does appear that there's a little bit of progress there and that we're seeing a change, correct?
There are some improvements, which is good. There's always a little bit of a shift year over year. The top two are still, I wish I saved more for retirement. That skews towards older people, which is probably no surprise. They're the ones realizing as they approach retirement that they're running out of a little bit of time. And credit card debt is number two. That's usually up there. What we saw the biggest shift in is the regret around, I wish I saved more into an emergency fund. That fell considerably. And a lot of that comes from people feeling a little bit more secure that they have that foundation. We saw over the past years, people got payments during COVID. Wage growth was higher, even despite the fact that we've had rising inflation in 2022 and 2023 and potentially a resurgence this year. People are better off with higher levels of savings in cash and in money markets or high yield savings accounts. If you look at some of the stats that includes both personal and sort of institutional savings, there is somewhere in the neighborhood of about $7 trillion sitting in money markets. And that's an all-time high. And a big portion of that is households having more cash available to them as a cushion.
You know, you talk about all that cash that's there as a cushion. The thing that I don't see realistically listed pretty much in the entire list is I wish I had invested more aggressively. I wish I had taken more of a chance and let the stock market work for me, or those sorts of things. Is that not a regret? Like being too conservative and not pursuing enough with your money just from what it can earn is not something that people feel bad about?
Yeah, that's an interesting point. That's not something that we've seen. We haven't seen responses that are saying I've been too conservative or I could have done better around investments. We ask people what they think might have improved their finances or their situation today. A small proportion say better stock market returns would do that, but that's a very, very small minority and is dwarfed by people saying things like cheaper essentials, lower rent, the better job opportunities, higher paying work, lower interest rates. All of those things are far higher proportions than just stock market returns.
Yeah, I guess the positive is that while nobody was saying, oh, I could have gotten better market returns as a regret, and I didn't do that, at least they're also not saying I got ripped off and invested in some Ponzi scheme or that meme stock I bought. That's my financial regret. You're not getting that either.
Not getting that either, which is a very good thing. And, those things are happening, but those are not anywhere near the biggest regrets that people have. And one of the reasons I think that is, although more and more Americans are participating in the stock market, often through 401ks, we're seeing 401k participation rates at all-time highs at over 50%. People's wealth for average Americans is still very much in their homes for those who own. And so things like, having a low mortgage rate or the ability to refinance or even get on the property ladder, those are more important to most people because that's where they find that they end up having most of their wealth.
Stephen, really interesting stuff. I appreciate your time. Hope we get a chance to chat about stuff like this again down the line.
Happy to do it in the future. Thanks so much, Chuck.
That's Stephen Kane. He's a financial analyst at Bankrate.com. And you can go to Bankrate.com so that you make sure you don't have regrets about like paying too much on credit cards and all the things that they do when it comes to rates and the rest. But if you want to find the study we've been talking about, the Financial Regrets Survey, well, look in our show notes for a direct link there. And I'll tell you what, if you don't want to have any regrets about living the money life, don't go anywhere because we've got more talk to come in just a moment.
Asset managers, you know how hard it is to stand out in this crowded space. VettaFi is a unique partner that can help you across the entire product lifecycle. With a best-in-class index factory and an award-winning digital marketing team, VettaFi can help you build the products of your dreams, optimize your distribution efforts, and grow your assets under management. Learn more at VettaFi.com.
Welcome back to Money Life, where I want to give you an update on something that has really been impacting my life. I've talked about it a little bit on the show, and it's not going away. And this segment may be a little bit stream of consciousness. I kind of wish it wasn't, but it's going to be that way because there's a lot of stuff that still has not been resolved. But I also want you to know what's going on, and I want you to react if any of this is happening to you. So what I'm specifically talking about is the fact that I was hacked recently. I mentioned what happened. I very much appreciate a number of you gave me suggestions for getting my computer right. But the situation went from suddenly there's an email going out. Please, if you got it, was inviting you to a party, don't open it because it would just get you infected, to I had money stolen. And how this happened and the level of sophistication and the fact that I keep talking to people who have their own variations on this theme is stuff that I really want you to know about. I had money in an account for my lacrosse league, the one that is currently out of business because we haven't been able to get a new barn after the one we played in burned down. And we're trying, and we'll know soon if we're going to have a league. But I had some funds that I kept in a separate account. I put it into an internet bank, picked it from Bankrate.com, FDIC insured, et cetera, paying like 4.5% when I first enrolled there. The bad guys got at one of those accounts. The way they did it, I've never seen anything like it. Maybe you'll be familiar with this, maybe you won't. They wound up getting access because of whatever they had gotten from my computer. They then accessed the account. Why they didn't access other accounts that might have had more money or what have you, I can't tell you. But they accessed this account and they put on a funding account. So if you've ever had an online savings account, you have to go say, okay, here's where the money's going to come from. And so you connect your brick and mortar bank to this online bank. And usually they do it with, here's 2 little deposits. We'll do a little thing. They might have a different verification program, but you verify your bank. You can have however many banks you want to have that you're moving money around to and from, etc. So in this account, I wound up with 2 different funding outside banks, my brick and mortar banks. But the bad guys here, they set up a third account. And then they moved 2 different $1,900 withdrawals to their account. But it all is happening in my account, and it all looks like I'm doing it. Now you'll go, how did you not know that this was happening? Well, like many folks, I have a number of different email addresses, and I have one of them that I use for things like financial subjects and transactions. I wasn't really making any transactions. I hadn't moved any money. I hadn't done anything else. So I wasn't looking for anything. And I don't really go there unless I'm going, when is something going to arrive? Did something go through, etc. So I hadn't gone there. But even if I had, I might not have noticed. Because with all the hacking and everything else, at some point I go to a website where I've changed all my passwords. I'm doing all this other stuff to try to protect myself. I can't remember the new password. So I say, send me a verification thing. Not to the bank, just to some other thing that I've got a relationship with. And I don't get the verification. And I'm like, that's weird. I try it again. I still don't get it. I then try to send an email from myself, one of my accounts, to this account that is where I normally register my transactions. And as I'm watching, I now see that email flash into my inbox and then go away. And I'm like, that's weird. Has something about resetting my computer made this all spam? Like, is it making me think that I'm now spam? So I go to my spam folder. But no, none of the emails are there. I know I saw it, so I go to look in my trash folder. And in my trash folder, well, there's the verification I had requested. There were my test emails from my other stuff. And there are emails going, hey, you requested to add this account, and we've done it. Then there's the ones that say you moved $1,900, and then you moved another $1,900. And that's when I knew I had been ripped off. But I still didn't understand what was going on. Well, what they had done is they had gone into my email. They had put on a filter that basically sent every email that was coming in to trash. Their hope was that they could move some things that would come off of whatever accounts they were scamming me on and send that immediately to trash. That I wouldn't notice, they'd get away with it. And that's indeed what happened. But now I knew. So the next morning, because the bank was closed, I contact the bank. They say, you've got 3 accounts registered. I said, no, I do not. They say, yes, you do. And that's when we find, when they're saying, oh, there's a 3rd account here. This was just put on. That's where the money had been moved. That account was still there. I say, why don't we just try to process the money back? They say, that's a great idea. Let's see if it works. Transaction, well, it looked like it was going through. Then it wound up being turned down for insufficient funds. For the record, I should have not gone after $3,800. I should have gone after 100, then 200, then 300, then 400, or whatever. Just keep asking, because it would have put through anything where there was any money left. And I believe they left it open, not because they thought I was coming in, but because they were going to try to take the rest of the money in the account. They hadn't taken all of the money in the account. But unfortunately, what we now know is that no, the transaction didn't go through. It was turned down because they didn't have sufficient funds. And what we believe was happening is that they moved this to their bank account, where they then loaded it onto basically a prepaid credit card, and they went out and spent that money. When we found out that things did not go through, the investigators from the bank say, yeah, you may get some of your money back, but you're probably not going to get your money back. Now, mind you, I was robbed. I had a bank. They allowed a fraudulent transaction. Like, is this what's going to happen? That I'm really not getting money back. And that's where we are right now. Right now, they're sort of saying, yeah, we don't think you're going to get anything. And this is where, I've got a friend in the financial world. In this case, it's myself. We're looking hard at this and coming back at them. Why? Well, there's something called Regulation E, which basically says that if your bank account is hacked, the bank is responsible for unauthorized electronic fund transfers from personal accounts and must reimburse customers. But the liability that you have as a customer depends on how quickly you report the fraud. The protection is under the Electronic Fund Transfer Act, implemented through Regulation E. If an unauthorized transaction appears on your statement, if an EFT was made without an access device like your card or your PIN, and you did not realize your device was compromised, well, if it happens within 60 days of your statement, if you notify your bank, you're not liable for fraudulent transfers. So I think that's what's going to be covered here because I found it within 2 days. So this is what we're going to be fighting through. Meanwhile, what have I done? Well, obviously, I've changed every password. I've done everything I can. I am doing as much as I can without my computer, even though we think it is fixed, because it's going to my computer specialist and it's going to be basically washed and scrubbed while I am off meeting my grandson and then going to FinCon. It's going to be pretty much put back to zero just to make sure there's still nothing here. And I will tell you, I'm still freaked out and don't really trust much of this. But I have also filed a police report locally. Can they do anything? No. But you still want to file that report, especially because we are trying to prove that there was fraud and that that's what we're wanting the bank to be liable for. I also filed a report with the FBI. They have a special website for it called the Internet Crime Complaint Center, IC3, Crime Complaint Center, 3 Cs, IC3.gov. I filed a report there. I filed a report with the CFPB, the Consumer Financial Protection Bureau, even though it's basically being gutted in all of the government actions right now. So yes, I still consider it worthwhile to bother making a complaint to the CFPB. I also contacted the credit agencies. I don't want anything being done to my credit. I have also enabled as much security as I can on all of my accounts. And you might go, well, it's a pain in the butt. Well, trust me, other things are worse as pains in the butt. And again, it's really hard to tell what is exactly going on. I know other people who have been hit by the same invasive, they clicked on something and it was, here's an invite or whatever, and they got infected. Some of them have the whole thing with the filters on the emails. And I urge you, because most people go, I've never placed a filter on me, go check. Because I have 9 different email addresses, some of which I barely ever use. They put filters on 5 of them. 5. So they were planning bigger things. I assume they felt they had me. They may still have me. I don't think so. But the entire time this was happening, nothing was showing up on any scans. So go look in your settings. Is there a filter? If you are missing emails, there's something you expect to be getting. That's where you're going to go look. You cannot stop being diligent. I got an email on Monday from my old credit union. I do not have an active account with them. They have not had my mortgage in many years. I do not have any money in any account there, but they were talking on the holiday about an attempt made on my credit through the old credit union. I still have the contact, so I will be spending part of my day today going to them. You have got to get vigilant. You've got to contact the credit bureaus and lock things up and make it that, hey, you cannot put anything on here. You've got to go off and put in the complaints and then see what you can do to fight this. I'm lucky. I've talked to people in the last couple of days where they lost 10 times what I lost. I also know others who have been luckier. The guy who sent me stuff that I believe led to me falling victim, he got off without being ripped off, at least as of this point. But they went after his Schwab account and basically were getting ready to try to rob him blind. And Schwab luckily caught it. but you can't assume it's going to be caught. And by the way, when these people had control, they were doing things like turning off virtual private networks and other stuff to make it that I was increasingly vulnerable. And yet nothing was showing up when you go to run antivirus software. It has been awful, dreadful. This is no fun. I am still shutting off my computer literally anytime I am away for a matter of minutes just to make sure, because until it has been brought back to zero, I'm not sure I'm going to trust it. But I'm hoping that I can do what's necessary, file the complaints and the rest. If you've got questions, concerns, and more, ask them. If you've been through this, tell me what your experience has been. We should share this. It's going to make us all smarter. Protect yourself. It's really serious. And when it happens to you, this is awful. But thankfully, living the money life is not awful, generally speaking. And the show, definitely not awful. We'll be back in just a moment with a lot more to go. Now Money Life looks at what the survey said. Welcome to The Survey Said on Money Life, where we dig into surveys, studies, polls, any kind of research or data that's going to help us understand what people are doing for, with, and about their money. And today we are looking at the latest out from Clever Real Estate. It talks about what happens when an Airbnb moves in next to you, or when your neighbor decides that their house is now should be an Airbnb. The folks at Clever surveyed Americans, and only 40% think that Airbnbs make good neighbors. Roughly half think that short-term rentals should be banned completely in residential areas. If you've been reading headlines, you know that this is a thing that's been coming up in a lot of residential areas. If you want to learn more, well, this is done for the anyestimate.com site. If you go find Nick Pisano, my guest, on our guest page, or where we mention him in our show notes, you will find a direct link. But Clever is at listwithclever.com, and Nick is an analyst at Clever Real Estate. Nick Pisano, great to have you here on Money Life.
Thanks for having me, Chuck.
I'm not surprised, but let's follow the logic here, because truthfully, if an Airbnb is next door to you, you probably have a reasonably nice place, or you have an okay place. Is it just that your neighbors are now renting to riffraff? What are the basic problems that make it that when people wind up finding out that there's an Airbnb next door, they're thinking, there goes the neighborhood?
So that is actually a pretty good way to put it, at least you're living in a desirable town or desirable neighborhood or something. But people's concerns about Airbnbs in their neighborhood basically seem to come down to two things. One, that they feel like it'll kind of degrade the quality of life, that they're worried about crime, they're worried about noise, they're worried about parking issues. And the second thing is that they're worried about the value of their own home. They're worried about how other people might perceive a neighborhood that has one or more Airbnbs, or if, you drive down the street when you're looking at a home and you see the Airbnb party house, and suddenly the people that might potentially want to buy your home are thinking they're going to look in a different neighborhood at that point.
But some of that is circumstantial, or some of that maybe it depends on if what you have next to you is the party house. If you've got a place and somebody is just they're renting a unit, they're renting their in-law apartment, they're renting their house, but their house is small and it's not bringing in, hordes of college kids or whatever, or their house is really big and really fancy and it's not bringing in those folks either because of the amount of money it would cost. Does that change things?
Well, people generally seem to be not thrilled about the idea of pretty much anyone staying in an Airbnb, regardless of the type of house, the type of community. We asked what type of people would they be supportive of staying in your neighborhood in short-term rental. And in terms of a majority, only one group got a majority, and that was an older couple. 67% of people said they'd feel comfortable with an older couple in short-term rental. Even business travels were at 46%, solo travelers 45%, and then it goes all the way down to, only 5% would be comfortable with a group of college students or a large group of friends. So people are very worried about this. And generally speaking, it doesn't seem to matter too much to them whether or not their neighbors are hosting loud parties or all this other kind of stuff, because 49% said they would report their neighbor if they found out they were illegally operating an Airbnb, even if they didn't have any problems with them. Even if their neighbor was, the guests were quiet, there were no parking issues, no trash or noise, they'd still report them just because they don't want that next to them.
That's really interesting and maybe a little bit alarming. I suppose maybe it's also probably how you read that question, right? Like, which of my neighbors is good? Which of my neighbors I wouldn't care? And they're operating an Airbnb. That might be other factors. But, talking about the neighbors operating Airbnbs, one of the controversial things about Airbnb has been, of course, that there has been corporate ownership of properties where certain communities, I think about New Orleans because I think that's the one that's gotten the most press, where corporations have basically bought up a lot of the properties that were available so that they can rent them, and those things can become the party houses. And it hasn't been the homeowner renting out their place. It has been a company that turned this into a de facto hotel. Does that impact any of this as well? Does it matter who owns it? To the same way you said, it doesn't make a difference who they're renting or what they're renting. Does it matter who owns it? Like, if my neighbor, it's okay. If it's the corporation that bought my neighbor's house, that's not so okay.
It's not the top line number, I guess, in terms of things that would matter the most. But we did ask people in terms of, the people who are opposed to the idea of Airbnbs in their neighborhood, is there anything that could convince you to drop your opposition? And among those things that we asked them was, what if your town put in restrictions against corporate or multi-property hosts? So, someone who's buying up a bunch of different houses in the neighborhood and turning them all into Airbnbs. And only 23% said that would make them reconsider their opposition. So I would say there is a small, and I would say, I guess, relatively significant group that could be convinced by, kind of getting the corporate business element out of this and just kind of neighbors who need to rent their home out for a little bit. But it's definitely not the majority.
What about folks who actually use Airbnb on their own? Like, did it make a difference if the people you talk to rent Airbnbs for their own travel and their own stays versus somebody who doesn't rent an Airbnb, but who is more thinking about, again, there goes the neighborhood?
It didn't seem to matter too much whether or not they had, been in Airbnbs themselves or how their experience was with that. We found that actually even almost only a bare majority of respondents even felt positively about staying in an Airbnb at all. We found 51% were open to it for a weekend vacation and 52% for a week-long trip, which to me surprised me a little bit, that I expected people would be a little bit more open to it. But it's perhaps the idea of people have heard so much, negative consequences from having these in neighborhoods and stuff that they just don't want anything to do with these kind of companies anymore.
Yeah. I mean, obviously, people who have had good experiences, they're going to feel differently about it than other folks. Really interesting research because, again, this is a thing that has been in headlines in the communities where it's impacting. And I can understand it because on the one hand,
there's no place like home.
And on the other hand, the value of your home and everything you're experiencing at your home changes a little bit based on your neighbors. Nick, great stuff. Thanks so much for joining me on Money Life to talk about it.
Thank you so much for having me.
That's Nick Pisano. He is an analyst at Clever Real Estate. Listwithclever.com is the website, but their sister website, anytimeestimate.com. And again, that's where the Airbnb study is. We have it all linked up. And, there's no place like home. There's no show like Money Life. So stick around. Money Life will be right back.
Did you know that global generalizable robotics represent a $24 trillion investment opportunity? Top robotics and AI companies are actively reshaping industries across sectors. Learn more about capturing this investment opportunity at Vetify.com.
John Cole Scott, president of CEF Advisors, is here. We're talking closed-end funds. Welcome to the Market Call. This is the Money Life Market Call, the part of the show where we talk with experienced money managers about how they do their job, what they look for that determines their buys and sells, what they see happening broadly on the market, and how they put it all together. And returning to the Market Call today, for the first time since 2019, John Cole Scott, he is president of CEF Advisors. He is the chairman of the Active Investment Company Alliance, and he's been on the show plenty of times since 2019, but he hasn't been in the market call. John, of course, as president of CEF Advisors, chairman of the Active Investment Company Alliance, is on The Navigator, our closed-end fund segment, all the time. But he's here in part because, A, he's helping me out. As you know, if you listen to the beginning of today's show, we had some adventures over the holiday weekend and we were going to be in scramble mode. And John and I happened to correspond over the weekend. And he's like, hey, you need a hand? Glad to get him. But also, I wanted him back because, well, if you are familiar with John, when he was on the show in 2019 and until recently, we would always say closed-end fund advisors. That was the firm started by his father, George Cole Scott. It's now CEF Advisors, and they have combined the two websites. He used to have a website for the firm and a website for the data, but it is now cefdata.com. And although we're going to be talking closed-end funds and BDCs here, you should know that the website now includes some research, not every ETF out there, but what they're calling their ETF select files. And that's currently more than 300 US listed ETFs that John will explain sort of how they're using them. But if you're looking for more information on ETFs, you will find it here as well. And maybe someday we'll have John back on the show doing the market call on ETFs. But today, focused on closed-end funds. And if you want to get more information, if you want to see how your funds stack up, cefdata.com. Enough of all that. John Cole Scott, thanks for coming back to the show.
It is so fun to be back with you, Chuck.
So this is a different one for us because we're just digging into the methodology. We're not covering the big, broad closed-end fund industry. We're just looking at how you do it. So the market call, of course, always starts with methodology. And you buy a lot of closed-end funds, but we need to know what it is that makes the ones that you buy stand out to you and what it is that makes you kind of sour on others.
Sure. So it starts the base case of thinking about asset allocation for clients. Generally, for our clients at CF Advisors, the minimum allocation is roughly 35% equity funds or 30% credit funds for, I say, 95% of our resources we work with. And we generally put 2% to 4.5% as a general allocation per fund. That lands about 30 to 40 funds in a portfolio. We put BDCs as a credit fund. At a high level, we always want to look at the NAV, the manager, the sector as one core piece of our trifecta analysis. That could be the expense ratio, the performance, just really how they're doing their leverage, what their beta is, all the nuance of the regular NAV of the management team, of how they're putting stuff to work for their shareholders. The second piece, not uncommon, it's a dividend analysis. How is it overpaying, underpaying? How is it classified for taxes if you're a taxable client? Very important to understand whether there's return of capital that's benign or destructive in making those decisions to own or not own a fund or how to own the fund. And thirdly, so common for closed-end funds is discounts. But as you know, we caught for many years, it's not just absolute discounts, it's relative, peer group, and what's likely to happen based on the environment we're in, data-wise, economically, what discounts that could happen for an equity fund or a credit fund. And that's the trifecta we blend together. There's no perfect fund, Chuck. We try to make a portfolio of the best weighted allocation that gives the most certainty for those three important things for our clients.
One of the things is that you are what some people would call a dynamic allocator. You're going to be moving money around. And one of the things we talk about as we get towards the end of every year with you is, tax loss selling and making the most of your tax benefits. Closed-end funds are great for that. You kind of say, oh, I bought a fund in this space. It hasn't performed well since I bought it. I'll take the loss. I'll cycle over. But how much buying and selling do you do in the interim period? In other words, if you got a fund and it's muddling along and you're thinking, hey, I'll be watching this at the end of the year, but here we are in August or getting into September, how, do you do much trading and swapping in the middle of the year if a fund is just kind of on an ordinary path?
Yeah, so what I can say is we are both very active for taxable clients with terrible taxes and those in qualified plans that don't care about taxes. It often stems from most of our clients, about a third of them don't really take any meaningful yield out of the portfolio. So every month and quarter, there's all this surplus to invest. And then we're deciding what can we nudge and rotate with the updated economic data and the ways to make select and choices and focusing those dollars every month. But even for those taking money, it's just a smaller amount of money, but we do that for them as well. We're looking at that. Honestly, there were big trades we gains we took in January for a couple of funds from years ago. And now I've done tax loss selling for some of our clients 6 times before September because I took some long-term capital gains that were terribly beneficial because we made money, but terrible for taxes. So now I'm looking for every meaningful loss almost weekly for our larger clients, trying to make their taxes generally less terrible next April. Again, if the market goes up 20% from here, we'll take it, but we're going to try to capture every relative loss to make it more nuanced. And it's also, we'll lean between sectors, whether equity sectors or credit sectors, whether high yield or senior loan, infrastructure versus MLP, based on where we feel the NAVs. Or healthcare now feels kind of cheap, so we're overweighting that relative to other funds because we think there's more upside to different sectors for the next 3 to 6 months.
I'm going to get back to that in a second. But how much does this mean that functionally you're dating your funds, you're not marrying your funds? Because it's important for people to understand that difference. As an individual investor who buys closed-end funds, which I do,
Yep.
I want to hold them for a while. I'm looking for the income component or whatever it is that I want it. I want to narrow the discount. I want to do all those other sorts of things. And yes, I would move if I saw something dramatic happen. But without that dramatic thing, I would prefer to have a fund that I can hold for a long time and be satisfied with. That's not always the way you see it.
So there are funds that we like the NAV, and we're always looking whether we should be adding to it, or even funds we've loved recently that we papered off because they gotten too expensive in our opinion. But you're definitely right. I mean, we have for almost 14 years, I have built what I hope to be the best nuanced data business in this universe because I need it. My partner, Dan Silver, needs it. Not everyone needs it, to be honest, but we have it. If you hire us as a firm, we're charging you a fee. We don't work for free. Our fees aren't terrible, but they're not zero. And so we must figure out a way to, take incremental gains, cut incremental risk, and be intelligent but diversified so our retired investors can go and see their grandchildren, go on vacation, and not worry about the headlines because we built the system to do that. So we always say that the funds that you own don't know what you paid for them. So don't worry. If you have a big cost basis loss, but still a great fund in a good sector, you just timed inadvertently, doesn't mean you should sell it because it has a big red number. If you have a huge green, that's a qualified account, but still reasonable discount, and you like the fund, there's no reason to sell because you made money because it's still a good forward-looking expectation.
So you talked about liking healthcare, but you also talked about how you will be making moves based on what you see with the broad economy, what's happening with policy and other things along those lines. So what are the areas of the market you like right now?
I mean, right now, I would say healthcare is an overweight on the equity side. We also really like the preferred equity market because you're getting a little bit less duration and still some reasonable discounts. And we find a lot of the leverage-adjusted NAV yields in those sectors are well below what preferreds are currently yielding. So we feel like the dividend upside is more secure than the dividend downside, which we never know what's going to happen, but we love that tailwind of possibilities. And then we also, again, inflation's a real thing. So we overweight right now MLP funds versus infrastructure at the firm, generally speaking, for most clients. But when there's discounts, deeper discounts help you lean into the sectors you should possibly overweight because discounts often revert. And if you can wait for more discount volatility and relatively, good core funds, you can maybe make some extra money or at least avoid losing money in the future, potentially at least.
And are there areas of the market right now you can't stomach?
Honestly, the hard stuff is, and this is partially not why we've ETF file. That's been a slow program, but a lot of the taxable bond funds are trading at 1 or 2 discounts to 1 to 3 or 4 premiums, even the names that aren't generally that high. So we've had to underweight and downsize the core funds of down to like a 2% if we really like it, from maybe a 4% position. And then this is where we've used some ETFs. There's better active ETFs now than when my father was managing money and hated the structure, where you can sit in a lower yielding, taxable bond fund in the ETF space and expect to wait for discounts to move 5 to 10% in theory, and then rotate back. And that's the way we are using them more likely, waiting for the net discount downside in a way that we weren't even 6 months ago.
So let's get down to brass tacks. What's a fund that's kind of the poster child for the methodology right now?
Yeah, so looking at MLP space, there's a Neuberger Berman Infrastructure Income Fund, NML. It's been on the podcast a lot, I believe, over the years, but it's almost a 9 discount. And one thing we love, at an 8 yield, look at the leverage-adjusted NAV yield and it's only 6.2, which is very, I'll say, easy versus the index of what the manager's doing. And we look at the leverage amount and the leverage cost and all of the nav of it. It's a very good fund in the space. The discount could widen, but it also could narrow. It's a great active manager that's well regarded in this area. And the beta is not even that high relative to its peer group. So it's a great example of a good core fund with possibly some discount tailwind going forward.
So again, that's NML, the Neuberger Berman Energy Infrastructure and Income Fund. What's something that's the evil poster child, the poster child for what you'd want to be selling right now?
Well, so there's a PIMCO fund, which is a great asset manager, but PHK, the PIMCO High Income Fund, is at a 6 and change premium, 7 and change over a peer group average. The manager has to hit over 11 to fuel that. If you look at its leverage cost is over 7%, and it's only 10% leverage. And so it's a really hard dividend to hit, in our opinion, over the long run. And the net asset value performance actually is better than a peer group average, but we're in a relatively benign market. There's a lot of things that could break apart in that fund. Dividends go down, discounts widen, a market event that just tells me that while it's not the lofty premium it had in yesteryear, it's still not an easy, I would argue, safe place to hold your money and a great place to rotate even to an ETF or a discounted closing fund and wait to see what happens. If that widens out, maybe buy it back.
And PHK, PIMCO High Income, has traded at a premium for a long time. So that's a problem as well. Like you'd go, okay, well, hey, it's gotten to a premium and it's gotten overvalued potentially, but chances are pretty good that a lot of investors bought it at a premium at this point, didn't they?
Possibly, but I talked to a prospect last week. He's owned it for a while. The NAV is outperformed. The discount is relatively narrow, historically speaking. I told him, you've won double twice. This is a qualified account. Take those gains and let's do something else with it because you've made I'd argue, excess money. It may not stop. Nobody knows the future. As you know, NVIDIA keeps going up, but it's a great way to say we've made some money, take it, pause. You can always come back. There's hundreds of funds to choose from, not just a few.
Well, now we're going to get your quick and dirty take on some closed-end funds that my audience is particularly interested in.
Quick and dirty.
Go ahead. Make my day.
Well, we hope we're making your day as we talk with John Cole Scott, president of CEF Advisors. He made my day by making it that we didn't have to do a rebroadcast or something else to fill in for a hole. So I appreciate that. But you should appreciate the information you're getting. And if you want to get more information, cefdata.com, their new improved website. And if he doesn't talk about your favorite funds, you can go look them up and find out what the firm is thinking about and how they evaluate them. You know how Quick and Dirty works. Again, you can send us requests for everything: stocks, mutual funds, ETFs, and of course, closed-end funds. Chuck at moneylifeshow.com. We're going to start with a request we got from Dave in Jacksonville, Florida. He wants to know about FFC. That's Flaherty and Crumrine Preferred Securities. He said you like preferreds.
I do. And this is one of those managers that's well regarded in this sector, but probably unheard of outside of closed-end funds. It's almost a 7 discount. Its yield is just over 7 as of the most recent data. And that's, again, the leverage to NAV yield is well under. It's a 4 and high change. It's, I would argue, very easy for this manager to pick what they want, almost regardless of the yield of the preferreds, to add really good value. Its leverage cost is very reasonable. Its leverage amount is very reasonable. So it's just a really good example. And the duration profile is just over 5 and mid-change. And so it's not a huge bet of interest rates either way. Dividends tax advantage, not tax-free like a muni, but it's a great place to build a better quality income piece of your portfolio at a reasonable discount. And you may remember, Chuck, preferreds in benign periods, usually the whole bucket, almost all trade above par. So that could be a future for this sector in this fund.
That's why we should buy now.
Yep, it's a buy on FFC, Flaherty and Crumrine Preferred Securities. Rick in York, Pennsylvania gets our next request. It's for Calamos Long Short Equity and Dynamic Income. That's CPZ.
CPZ is one of those CEF 2.0s of yesteryear pre-COVID. It's only at a just below a 6 discount, but that's relatively wide for the universe of funds we can choose from. We like it a lot here. We like that its beta is actually 0.19 versus SPY on a 2-year weekly basis. And it really has a nice yield of just over 10%. But, really only 7 and mid-change because of that discount and leverage, which we feel is a durable number that's repeatable by the manager over periods of time. And so it's a great way for a low beta NAV, somewhat of a discount, getting some income in the portfolio, but you don't have to worry, generally speaking, markets rising heavily or falling because it doesn't have a high beta allocation to equities. We use it a lot at our firm for our clients, that we loved it at a 15 discount. We still like it at a 5.
And look at all the money I'm making.
Yeah, you can look at all the money you're making. It's a hold on CPZ, Calamos Long Short Equity and Dynamic Income Trust. We sometimes say good company, bad stock. This is good fund, not yet priced for adding more, but worth holding. Dale in London, Ohio gets our next request. It's UTF, Cohen & Steers Infrastructure.
Well-regarded manager, a sector that really uses the closed fund wrapper well, but unfortunately it's at a 3 and change premium. Its yield is 6.98, so not an aggressive number. I don't worry about the yield here, but the pricing is just too much. This is a simple argument for a utility ETF and wait, because it's a great manager with a great fund, but just I don't want to worry about the weekend tomorrow in a position trading well above NAV when it doesn't likely live there for months at a time in the probable future.
And now for the profit taking.
Yeah, you got to where you've got the premium. Now you want to take that profit. It's UTF, Cohen & Steers Infrastructure, a sell. Our last 2 requests go to Al in Orchard Park, New York. The first is for PGIM, Global Short Duration High Income, GHY.
So this is one of those funds that was one of our core favorites for years. The interest rates were going to rise, but it's now trading like many of its peers, slightly over net asset value. I'd also say its leverage cost is close to 8%. And so it's just another example of a great manager that we love at a discount. Another example of maybe a high yield fund at a small discount, maybe a multi-sector fund at a small discount, or an ETF. That can happen too. It's a good fund, but it's risky today because we don't know the future.
You better quit while you're ahead.
Yep. And you have gotten ahead to a point, and that's why PGIM Global High Yield GHY is a sell. And last, again for Al in Orchard Park, Tekla Life Sciences, ticker HQL.
So this is one of the older closed-end funds, goes back to the 80s, and it's at a 7 and change discount. As I said, one of our overweights versus the market is healthcare, based on our feelings for the where it sits at the NAV, and this discount's attractive. However, it should be noted the yield is 12, which is a little bit higher than we would prefer. It used to have a 2% a quarter, which tells me that if you were to bake that into this math, it's about 8.8% of that yield is more long-term durable. So the key with this fund is we want to own it for NAV. We like the discount. It definitely pays us quarterly, but you should reinvest about 3% of the cash flow back into the portfolio, either this fund or somewhere else, or there is a risk in the future. But a great use of the wrapper, a great manager, and a great fund to own today with that caveat.
So,
buyer beware, dude.
Yeah, you've got to be somewhat worried, although it's the problem you kind of want to have.
And then you're going to find out your biggest problem is what to do with all the cash.
Yeah, you're trying to figure out what to do with all the cash on that yield from HQL, Tekla Life Sciences. That was a buy, but a cautious buy, a caveat on that buy because of the yield there. And speaking of good buys, we have to say our goodbyes. But John, thanks so much for stepping in. I know we'll be talking again soon. I look forward to that conversation already.
Always a pleasure, Chuck.
That's John Cole Scott. He is the president at CEF Advisors. Go check out their new website, cefdata.com, or their updated and upgraded website. Look there not only for your closed-end funds, but your ETFs. And we'll come back. We'll put a bow on this show. We'll let you know what's coming for the rest of this week and cross the finish line together. Also, something quirky about Quick and Dirty here today.
Everything an advisor needs in one newsletter. Go to advisorperspectives.com and see why 100,000 advisors are subscribed to our newsletter.
Always great to chat with John Cole Scott. I very much appreciate him coming in and stepping in. We were supposed to have Rob Thummel from Tortoise on. He was actually going to did tape 2 segments with us, one for today, one for the Navigator on Friday, taping ahead because I'll be traveling, and those interviews were lost. You do not need to know the technical reasons why. You just need to know that we will try to get him back on. But I appreciate John stepping in. It was a lot of fun getting to do this with him because we don't normally do it. I will point out that 2 different guys, Dale in London, Ohio, and Dave in Jacksonville, Florida, may have both had an interesting experience in that interview because both of them sent me new requests for the list, like Dale over the weekend, not very long ago for Dave. And yet during Quick and Dirty, the requests that got pulled were older ones that they had sent me previously. But when John talked about a favorite and a least favorite, so when he talked about NML, Dale just put that in this past week, like on Friday. So it got in only because we just did it, etc. And then Dave had asked about PHK previously. They weren't the ones that got talked about during Quick and Dirty. So my point is only, if you put something on the list and later you've changed your mind, like it's never come off the list or you haven't heard us talk about it, you're welcome to say, hey, Chuck, if I had this on there, please take it off. Because in the closed-end fund world, we don't do enough of them. If we got it off there and we got you the one you really wanted, great. Now, these guys both did get a request that was from their recent list. It just wasn't the one that we talked about in Quick and Dirty. That's a benefit. But I would have hated for Dale or Dave to go, yeah, I'm not interested in that fund anymore. Yet that's the one that got picked off the list. So don't be shy when you're sending us your picks of also saying, hey, I previously put this on there. You can get rid of that. Like, that's okay. We'll take it off. We'll honor your request because we're trying to make this as good for you as we can. Tomorrow on this show, Rick Pitcairn, Chief Global Strategist at Pitcairn. But we've also got a lot of great stuff coming. I'll tell you more about it tomorrow. Meanwhile, if you're looking for something to celebrate, well, it's Telephone Tuesday because telephone calls to businesses generally peak on the day following Labor Day. Several reasons, because it's a long weekend, because summer is ending and people want to take care of things they've been putting off for the whole season, because school is starting, people want to get things in order before, the school year gets really rolling or what have you. So it's been dubbed Telephone Tuesday. It's also National VJ Day. VJ Day, of course, victory over Japan, celebrating that from World War II. It's National Another Look Unlimited Day, which is about recycling things. Give things that you want to get rid of another look and find a new home for them. On the food front, National Grits for Breakfast Day. I don't really eat grits for anything besides breakfast. I don't eat them for breakfast that often, but okay, it's kind of redundant to me that you're having grits for breakfast. It's also World Coconut Day and National Blueberry Popsicle Day. Blueberry, not the flavor of popsicle that you think about all that often. But yeah, they're good if you can find them. My guests today were Stephen Cates, financial analyst at Bankrate.com, Nick Pisano from Clever Real Estate, listwithclever.com, and John Cole Scott from CEF Advisors, their new website, cefdata.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from John Rockefeller in honor of the Labor Day holiday. He said, I believe in the dignity of labor, whether with head or hand, that the world owes no man a living, but that it owes every man an opportunity to make a living. Well, we hope you're making your living however you're doing it, and we hope you're keeping money in its proper perspective in your life, which means that you're remembering, until we do this again the next time, the best thing you could do for your money is not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here again tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.